Well, post the very strong earnings season that corporate India has seen, and also a very, very conducive budget, whole host of economists, whole host of market watchers have gone ahead and upgraded both the Nifty EPS estimates and also the India economic growth forecast, thereby raising the GDP estimates as well. So Morgan Stanley is no exception. Their economists actually have written a note to the clients in the morning where they believe that there are more legs to this particular recovery that India is seeing. They've gone ahead and raised the India GDP growth estimate by 200 basis points for FY22 and by 50 basis points for FY23. And the reason for this is that they believe there is a supportive policy mix and a synchronous recovery in both domestic as well as external demand. They believe India is on the cusp of a virtuous growth cycle. Now what they have done is that they upgrade their estimates of India's GDP growth to 12.1% for FY22 from the earlier 10.1% and have upgraded FY23 to 6.7% from 6.2%. They expect growth to accelerate to 6% in the quarter ending March 2022. They believe economy will show a synchronous recovery with a pickup in domestic demand, consumption as well as investment, and they believe that external demand environment too will be quite conducive. Not only that, they expect the monetary policy stance to remain accommodative, and also the fiscal policy stance is actually quite conducive given the fact that it is following a growth supportive trajectory. They expect that the private CAPEX recovery will happen in the next 12 months, led by improving demand, given the fact that some of the corporate sector balance sheets have repaired quite significantly, a lot of deleveraging is done, and they also feel that the improving banking sector position is actually quite good. Given that, what they are saying is that they believe that the risks at this point of time are broadly balanced. They believe that the key risk could actually stem from COVID-19 related factors such as resurgence in cases, mutation in the virus, and issues with efficacy and distribution of vaccines. Other risks that they see are that faster than expected rise in inflation. They believe that there could be increase in credit stress domestically and wider credit stress. And also they believe there could be a slowdown in global growth, risk aversion in global capital markets, and given the fact that you could see some sharp swings as far as global commodity prices are concerned. But despite all of that, they believe most of the risk factors at this point of time are quite benign. They do not expect most of these risks to play out. They actually expect CPI inflation to be driven by the opposing impact of slower food inflation from a favorable base and demand side improvement, keeping core inflation quite sticky. They expect CPI inflation to average 4.5%, with core inflation actually being stickier near the 5.2%. So they expect a slow-paced withdrawal.